All right, guys. All right. So, welcome back to Dividend Investing, Dividend friends all over the world. It's been a long time. Have been busy with a couple of things, but now we're back. And what I want to bring up today is to share my portfolio matrix that I use to track my dividend portfolio and what I'm looking at on a month-by-month basis. So, I've been working on this. I've been making changes month over month, and so this is finally what I'm using today, and I want to briefly go over it, and maybe you find the one or the other metric interesting for yourself to implement it and look for it on your own portfolio. So the first thing I always look at, which is in the top here, which I call freedom meter. That's basically to keep me motivated, and what it is basically it's a reflection where I am on my journey. And if I reach 100%, that basically means I'm able to pay my bills all with dividends, and I'm like what you would consider to be financially free, right? So sitting at 17.09% at the moment. So you can say that's nothing. You can say that's awesome. I mean, I think the important thing is just that if you look month after month after month, and now I'm in this type of investing for about 3 years now, it has to go up, and it's going up every month. Sometimes 0.5% or even less, but I think that's important, and that's something I'm looking at, and it's keep me motivated every single month. Basically, there's a kind of a detailed calculation behind it. If you guys are interested, I'll share it. Basically, what you need to take into account, you need to find out what amount of money you would need to pay your bills, right? And then you would, of course, have to consider like taxes. Since I'm based in Europe, there's a little bit more tricky with the taxes. And then also what I did consider is some sort of a withdrawal rate, right? That depends. Got to figure it out for yourself, whether you go, what I did, would go with 3% withdrawal rate per year, or more or less, depending on your situation, depending if you have other sources of income, social security, and so on and so forth. But that's something I always look at, and I think it's very important to keep you motivated. You want to see it going up every month, and get a little bit closer to your ultimate goal. That's something I implemented quite a time ago, and I love to compare it from a month by month. What I'm actually doing, I'm doing a screenshot of this complete cockpit month after month, and then I'm looking at the progression. So then something which I also look at is what I call invested money yield, right? So what is that? That's quite simply, the way I look at it is quite simply the money that I put into the portfolio, which only relates to like the real money, that I paid, and it doesn't consider dividends or anything else, just the money that I transferred over to my portfolio, and I have that in relation with the income that is coming out of this, right? So at the moment, I'm basically able to generate 6.2% on the money that I put into the portfolio, which I think is really it's really a nice number, to yield 6.2%. And then if you look at the next line there, I have the average yield on cost of my positions after taxes as well. That reflects, there's a slight difference. That reflects basically the yield on cost of all of my positions on average, whereas the second line, it reflects the money I put in the portfolio compared to the income that it's generating on year by year, which is over there, right? I'm generating like looking forward on average, and on a typical year, I would generate slightly above $7,000 a year, And I put that in perspective with the money that I put in. It's somewhere there, 104,200 euros, which I put in. I'm always taking into account, obviously, the rates, euro-dollar rates, and so on. But basically, the difference, to keep it short, the difference between both is this one also reflects, the upper one also reflects the dividends that I would reinvest, right? So therefore, this yield, it grows, and it basically shows you the power of compounding, right? If I would have just started out and put, let's say, 100,000 euros and I bought stocks, then both of these, the 5.35 and the 6.20, they would be like the same number. But considering that the portfolio yields dividends month after month after month, which I do reinvest, right? Therefore, the actual, if I compare it in relation to my actual money provided into the portfolio, then I get a higher yield over time, and that's the power of compounding. Yeah? So I'm at almost a percentage point of difference, which comes basically from the compounding, which the dividends I received. I bought further stocks with the dividends, and these further stocks already now contribute to this 7.1k on an annual basis. That's very nice to look at it. I think that's also something that really helps you motivate to keep being motivated. To see this power of compounding like in a real number, to look at it month by month. Then obviously I'm tracking the portfolio holdings, 66 at the moment. I'm tracking the net asset value of the portfolio, meaning the current, let's say, market value of all positions. Also considering that I have a margin account, I might have some cash, or might be a little bit in debt, using margin to buy stocks. That's the current portfolio value. Something I also track, since as I said, I'm based in Europe, and basically my home currency is the euro. So I'm also tracking the foreign exchange impact on NAV. It's at the moment a positive 2k, right? So it's a little bit, in terms of portfolio value, it's a little bit favorable for myself. Then something which I started to implement to look at is the weighted average SSD score. That's basically, SSD means the site you might be familiar with, like this Simply Safe Dividends page, which has a number between 0 and 100 attached to each stock, which reflects the dividend safety. So what I like to do is to look at the average dividend safety of my portfolio, and the way I do it, I'll weight it, with the money invested in each of the stocks. I have the stocks here, the tickers, I have the shares, I have the cost base per share, and I have the total costs. And then here in that line, actually, I have the dividend safety from that page, which I update every month. And I'd like to calculate the average safety score of my portfolio, and I'm looking at it on a month by month. It doesn't fluctuate too much, but sometimes, the economical environment, it changes a little bit, so these scores are being lowered, and sometimes you have dividend cuts and so on. So I think it's reasonable to look at that, whether your, let's say, quality of your income is deteriorating, or you are buying more risky stocks, then it will go down, or you're buying more conservative stocks. So I try to keep it at around 70. I think that's a reasonable. Maybe in the future I try to get it up to 75, or even a little bit higher. Money multiple, that's basically a reflection of what we saw already there. Simply meaning that the money I put in it, I was able to, looking at the current portfolio value, I was able to get I'll get 0.17 times or 0.17 times the amount that I put in my current net asset value. And then something which I also started to implement, which is quite interesting, was what I call portfolio IRR. So basically, this is also a relation between the current net asset value of the portfolio, which is 120k of euros, and the money I put in. We just looked at it. I think it was 104,000. But the difference to the money multiple is, I'm not just comparing money put into what's the current value of the portfolio, but rather what I'm doing here is I'm keeping the timing of the deposits in consideration. So So I have a calculation back there, and if you guys are interested, it's not that complicated. It's basically the Excel has a formula which is just simply called IRR, right? It's down there. This is unfortunately in German now, but what you have to type in is simply IRR and then brackets open. And then what I have is here I have the deposits from the start of the portfolio, which I put in, that's the 104,200. And this is structured by the date where I put the money in. And now here is the current value of the portfolio of 122,000. And now this IRR, it considers like the time effect of money, or the time value of money rather. And what it does, it brings an average annual return, right? That's what it puts out, an average annual return, which is a little bit over 11%, which is a nice number to look at, because basically it says that on average per year, my portfolio in total, considering capital gains, of course reinvested dividends and so on, in terms of actual value or current value, not income but rather value, it's around 11% per year. Surely that can fluctuate a lot. I mean, when we have big down days like we had last week in the beginning and middle of August 19, then it will obviously go down. But I think it's quite interesting to see basically what in terms of performance your money yields. And then something that I started to implement now in that year 2019. Basically, what I'm doing, I already mentioned it in my beginning video. I'm trying to average out the monthly average income, right, that the portfolio yields, which is $596 at the moment per month on average. And I like to compare it to the year-end number from the last year. So comparing the year-end number from the last year, the 31st December of 2018, compared to that average monthly income I had at that point in time, now I have a growth of 12.6% at the moment, with the 596 dollars per month. And what I'm aiming for actually per year is to get at least a growth of 20%, right? So if you can keep that up, that would basically mean you would be able to double your income every around 4 years. I mean, you have to keep in mind that the 20% go on top of the the increased amount year by year. So it should be roughly around 4 years to double your income. And so as you can see, I have a little work to do in that year to reach the 20% of an increase. I think it comes out, if I calculate it, comes out to around 640 or something, which means I have to invest money into my portfolio so that I would gain an additional around $45 per year of income on average, which I'm trying to make it happen that year. Then something I have some sort of a, let's say, checklist, a quick here in the middle. What I'm looking at here is I'm trying to keep my yield. I'm excluding this one ETF, AMZA, which you might be familiar. It's a big loser, and it was a big mistake to invest a lot of money at the beginning. So I try, and it's a kind of a special ETF. So I try to keep it out for most of the the views I do on the portfolio, and I'm trying to keep the yield of the positions. I'm trying to keep the yield above 5%. I mean, it is 5.35 including this ETF, but I try to keep it above 5 or around 5 excluding this ETF. So currently almost there. It's fine. What I'm also trying to do, I'm trying to really limit my exposure to BDCs and mortgage REITs. I'm trying to limit it to below 15, but actually let me now at that point change it. Really looking to be really below 10. At the moment I'm at 7, maybe I'm looking to get it further down by just investing in other stuff, because I think that's something that will be hit obviously hard when recession kicks in at some time. Then what I'm looking for, I have clustered my shares into like sectors, and there's several sectors which I consider defensive. For example, utilities, REITs, and so on, where I say it's not so that a recession wouldn't necessarily impact those sectors the most. Also, healthcare isn't that defensive sector. Trying to keep that at least at 50. Proportion of shares, trying to have at least 75% in terms of investment in shares as compared to ETFs or closed-end funds. Closed-end funds, trying to keep it at 15%. Maybe I'll lower it also to 10. Currently 8%. That's okay. Don't want to have too much of a sorry for that. Don't want to have too much of an exposure in closed-end funds, right? Because they're leveraged, and so that's just a higher risk. Then I have a couple of exchange-traded notes, as well, as you might know, the two from the UBS, two of the those mortgage REIT ETNs, currently 2% of the portfolio, which is fine. Definitely don't want a higher risk. Then dividend growth proportion investment. I have 78% of my, let's say, funds is invested in real dividend growth investment as compared to, for example, bonds or zero growth. Then I have also classified my stocks to risks, and I want to see at least 50% within this lower risk category. Maybe I should even put it up, let's say, to 70. Given the time that we are in 11 years in the bull market now, I'm at 73, so it's totally fine. Trying to keep the low low risk stocks higher. Dividend growth income proportion is at 60% now. That's fine. Then I also have two, let's say, metrics which I follow, which is the dividend aristocrats in terms of investment, in terms of income. 33% of my investment currently. I'm aiming at 40, so I have to invest a little more in the aristocrats, and in terms of income, I'm aiming to be 25% from those shares. Almost there. It's good. Moving towards targets. Then I want to see all over my stocks or my positions in my portfolio, I want to see that at least 80% or more have never decreased their dividend. I'm at 82 at the moment. It's fine. I think that's something you should really try to have a look. Go through your positions, right, and see which of those have actually in the past, cut their dividend. In this column, I'm tracking it, and if I put a 0 here, these have never decreased their dividends, right? We have obviously the known ones. We have the Procter & Gamble's, we have the Pepsi, we have the Altria, and so on, which have never decreased their dividend, right? Coca-Cola, Walgreens, and so on. And there are some where it's in blue colors that have, cut their dividends, and I want to keep it at least at 80%, I think that might be relevant, when it comes to difficult times again. If a company has showed his willingness, or their willingness to keep the dividend growing, it should tell you something about a company at least. Or if a company, on contrary, is willing to easily cut when times are getting rough, right? All right, what else do we have? Now, this quite interesting. I categorized all of my investments in high dividend growth, medium dividend growth, low dividend growth, and no dividend growth. And this is something I'm also looking at. At the moment, I guess it's loaded towards the medium dividend growth, which is, I think I'm counting for medium. I'm counting, I think, everything which is above 4%. But below 8 or 9 or something like this. Above it would be considered high dividend growth, and I'm looking at the dividend growth of the last 5 years, and then I'm seeing whether that's above 9%, it's more in the region of 5%, or if it's lower dividend growth, which is the typical AT&Ts of these worlds, 2%, something like this. And some of the positions, obviously, in particular, the exchange traded notes, but also I have several PIMCO and BlackRock bonds. They don't increase or let's say most of the time they don't increase the dividends. That's a no dividend growth. I'm trying to move it a little bit up, decrease the no growth a little bit, and try to focus in this medium juicy area, right? To get it above to 50% towards. Then something else I'm looking at in this next category here, in the next blue shading. I'm comparing dividends declared in this year as compared to last year. Sitting at 93% at the moment. Now we are talking mid of August. So basically a little bit more of dividends in that year, and I've catched up with a full year amount of the last year, and then everything else goes on top. Basically it's a reflection also of this 12.6 dividend payback. Something I'm also looking at. It's basically that window. It's basically something I have put here. It's what has the company repaid in terms of investment, right? And I have some, for example, this what I also already mentioned, this ETF AMZA, which I simply add up all the dividends I've received from this fund all over the time of the investment, and then I put it in relation to the money that I invested, right? I invested the $9,600 in that fund, and that leads to a repayment ratio of 37%. So as soon as you would hit 100%, obviously, then you would have the investment would have paid back to you all of your original investment, and it would just then continue to put out dividends on free money, basically. So that's related to the time you are invested in the market. Portfolio margin leverage. I'm trying to have a look at to what extent I'm using my margin account. At the moment, 1.6% of my net asset value invested is basically borrowed money. And then there is something about transaction costs. I'm trying to keep a look at in terms of dividends declared, in terms of total invested money, in terms of month to cover the annual transaction costs, and also I'm doing in relation to options income. So just trying to get a feeling, on these commissions. What does that mean in relation to different metrics in your portfolio? Is it really, like, let's say, relevant? Is it totally impacting your portfolio? What's going on with the commissions? Trying to compare it from year to year. It's fine. And then finally, that's something that also helps me to keep it motivated a lot, down there in the bottom. What I'm looking at is, we touched it, the annual net proceeds or annual dividends, roughly $7,100 over a year. Then I'm looking at the monthly, $596. Also looking at the daily, what does it $19.59 bucks per day, which when you think about it is really nice, right? It's really nice. I will be hitting $20 per day in the next month probably. So if you think about it, right, you have 7 days in the week, 365 days in the year. So no matter what I'm doing, if I'm on holiday, if I'm sick at home, if I'm working, if I'm traveling, what just no matter what I'm doing, I'm getting $20 paid per month, and that's really nice if you think about it, right? At first it sounds like, okay, $20, whatever. That's two lattes, right? And then it's gone. But that's the power of the passive income, right? No matter what I'm doing, if I'm spending money, if I'm not spending money, if I'm sleeping, no matter what, it's $20 in the bank, and that is also something that keeps me motivated, right? To get it up, obviously, to higher daily amounts. I even you see it here. I even calculated it down to hourly net proceeds, which is 82 cents per hour, and also per minute net proceeds, which is at 1 cent for a long time now. You can see I'm at 1.4 cents per minute in terms of dividends. So I might be able to actually get it up to 2 cents now that I think about it, right, in that year. So it will probably round up, right, as soon as I get another 1/10 of a cent per day, per minute rather, then I would, in terms of rounded number, I would look at 2 cents per minute. It's nice. I mean, if you think about it, it gives you a better, it gives you a better grip on your portfolio. So I like to do it, to break it even down into this minute. And then also interesting, total dividends received. It's really impressive. I mean, since I started in the beginning of 17, I received $12,503 in dividends. Obviously, all of which I reinvested into new shares, new positions, and that's amazing. Huh? You start small, and then each month it goes up, and you compare it. You compare it month over month over month, and then you just see, wow, that amount of money has been flowing into my portfolio, buying new positions. It's really nice. So, yeah, that's what I'm looking at every month, guys. I hope you get something useful out of it. Try to maybe build it in your own in your own monitoring of your portfolio. And in the next episode, which I'm trying to do at the beginning of September, I'm gonna look at, let's say, what happened in the month of August in my portfolio. I've bought a couple of things, I've sold some positions, and yeah, that's what we're gonna look at next. And then I will also try to compare this portfolio matrix with the, let's say, month by month development and see what that means. All right. So thanks a lot, guys, for watching. Please obviously hit that thumbs up. Try see if you get value out of it, and if it makes sense for you to subscribe. Would be happy to have conversation down in the comments below. And great. See you guys in the next time. Bye.